This week on the show, I'd like to talk a little bit about early retirement. Not so much the really early retirement that is semi-popular these days, financial independence, retire early, but semi-early retirement. And what I'm really getting at here is for the majority of us, we're saving for our own retirement in some kind of tax-qualified account, like a 401k plan. If you own a business and maybe you have a personal defined benefit plan or a cash balance plan on top of that, maybe IRAs, Roth IRAs. There's just a litany of reasons to utilize those accounts when you're putting money aside for your own future to enable your future financial success and open up the window for retirement at some point. I'm through this in a couple of different ways. The first option, okay, if you're someone who wants to retire before age 59 and a half, you're trying to figure out how to get around this 10% early withdrawal penalty, which is exactly what you should be doing. One option is to consider distributions from your 401k before IRAs or Roth IRAs. Now, you also have what are called substantially equal periodic payments. I mentioned that a minute ago. Substantially equal periodic payments are a way to circumvent the 10% penalty with balances in an IRA. So let's say that none of those 401k options are really a good fit for you. Maybe you're not 55 yet, but you have a ton of money in the company 401k. So you leave work, you retire early, and you decide to roll those balances into an IRA. Substantially equal periodic payments are also known as Rule 72T in the tax code, or some professionals will refer to it as the 72T distributions. And the idea here is, yes, you're not allowed to take money out of the account before 59 and a half free of penalty, but if you agree with the IRS to take a set amount out every single year, they will allow you to avoid the penalty. And the other thing I kind of skipped over here at the beginning was if you have a taxable investment account, so an individual brokerage account in your name or in you and your spouse's name or in the name of a trust, that's very likely the account that you want to pull distributions from first. There's no holding requirements there. You can do whatever the heck you want with it because the IRS is taxing you on the gains, on the distributions every single year. So the easiest answer here, if you want to retire at 55 and you have a taxable investment account and a traditional IRA, a 401k, and a Roth IRA, well, you just sell assets in your taxable brokerage account first, raise the cash you need, pull that cash into your bank account, and use that to pay for living expenses.